What's up, everybody? Gen X Dividend Investor here. In this episode, I'll compare the pros and cons of dividend income versus creating your own dividends by selling shares, both of which allow you to live off your portfolio. I'll end things telling you about my Memorial Day weekend trip visiting some out-of-town relatives and the insane asset that I found that my brother-in-law is invested in. And to quickly level set things for new investors or wannabe investors, a stock just represents a small piece of a public company that you can buy using brokerages like Fidelity or Robinhood or what have you. Some companies, especially well-established, profitable ones, pay dividends, which are regular cash payments made to shareholders from the company's earnings simply for holding the stock. So the more shares you own, the greater your dividend payment can be. For example, check out a stock I own in Pepsi. Today it closed at about $131 a share, and it pays a dividend of $5.69 for each share you own over the course of a year. So if you bought 10 shares of it today, that would cost about $1,313, and it should pay you $56.90 per year in dividends, spread out over 4 quarters since it pays quarterly. One cool thing about dividends is that even if the stock price falls 50%, it doesn't automatically affect the dividend payout. The only way the dividend payout per share is changed is when the company's board of directors votes to change it. That being said, while stock price drops don't directly affect dividend payouts, it can signal financial trouble. And if the drop reflects poor company performance, then the board might cut dividends at some point. For reference, PepsiCo has paid consecutive quarterly cash dividends since 1965, which was before I was born, and 2025 marked the company's 53rd consecutive annual dividend increase. Its products are enjoyed by consumers more than 1 billion times a day in more than 200 countries and territories around the world. But it is facing some headwinds that have pushed its stock price down lately. Its market share has struggled against some of its competitors. Its demand has been impacted as they raise prices, coupled with changing consumer preferences for more healthy foods. Plus, global economic uncertainties and tariffs have all negatively impacted Pepsi's price. These days, some people are selling it because they're concerned that its free cash flow is weak and that support of its dividend is at risk unless business fundamentals improve. Others see right now as an incredible buying opportunity, and that's kind of the nature of investing. One person's risk is another person's treasure, and time will tell who's right. Pepsi is called a dividend king because it's increased its dividend for 50 plus consecutive years, but that doesn't mean it will continue being able to do so in the future. I mean, we've seen other dividend kings who cut their divvy when their business stopped performing well, including 3M and Leggett & Platt. And Walgreens Boots Alliance was almost a king, as it had 48 consecutive years of dividend increases until it dropped the ball and stopped paying one. I shared those examples to simply make the point that nothing lasts forever, and the past can't predict the future. I personally continue to stay long with Pepsi, but I don't have a crystal ball to know what they'll do, though I'm currently thinking their management team will figure out a way forward without cutting. I have 768 shares of Pepsi worth about $100,000, and it pays me about $1,092 every 3 months, or about $4,370 a year. I've been getting Pepsi dividends for a long time, without doing anything other than my original buys, which is why some people feel that quality dividend stocks are the best form of passive income out there. I hope Pepsi will continue to pay dividends and raise them over time so that one day, even my great-grandchildren will benefit from the investment decisions I made long ago. Pepsi actually announced a 5% dividend hike 3 months ago, and I don't think their management team would hike by that amount unless they were confident in their ability to perform, but only time will tell. Okay, now that I've covered the basics of how dividends work and how dividend income can be a key part of living off a portfolio, it's also worth noting that many investors rely on another common strategy, selling shares. Ideally, they sell at a higher price than they paid, generating additional cash flow. And then some people earn interest on the cash in their portfolio, and some generate portfolio income through option strategies on their tickers. So don't think of living on a portfolio as only dividends or only selling shares, as most people will usually do both. But some people, like myself, often try to avoid selling shares as much as possible because the longer you hold, the more your investment can benefit from compounding, more your gains start earning gains themselves. And selling early can cut that process short. Plus, selling shares usually triggers capital gains taxes, which can take a big bite out of your returns. But getting dividends can also have tax consequences, so always understand your tax implications. Holding stocks long-term, like over a year in the US, typically qualifies you for lower tax rates, and the longer you wait, the more tax can be deferred or even avoided altogether if done strategically. Trying to buy low and sell high is the goal when selling, but it's often easier said than done. Staying invested helps you avoid missing the best days in the market, and those days often make up a huge portion of long-term returns. Also, frequent buying and selling often leads to more stress, emotional decision-making, and inopportune timing. Long-term holding reduces those risks. Finally, I found that holding shares long-term encourages you to think like an owner rather than a trader. You tend to focus on the company's long-term performance, not short-term price swings. So bottom line, long-term holding is usually the most tax-efficient, stress-free, and wealth-building strategy for the average investor, and all that aligns to why us dividend investors push hard to avoid selling shares. Now, a common goal for many investors is to grow their portfolio as large as possible before they start using it. That's kind of the point behind buy and hold investing. And if you don't have dividend stocks, then you run the risk of bankruptcy causing you to lose 100% of your principal, whereas at least with dividends you slowly recover some, and potentially all plus more, of your original investment. That being said, most buy and hold dividend investors reinvest their dividends they get, so if their company went bankrupt, then they'd still be SOL, and smart people tend to reinvest for as long as they can to let compounding do its magic until they need the cash. But hey, not everyone follows that path. Like, some people need to start drawing from their portfolio sooner than they'd like. They might sell shares or use their dividend cash to cover immediate needs, like a down payment on a home, unexpected job loss, or a new opportunity they want to pursue. So even if someone's portfolio isn't massive, it can still provide some extra financial support and flexibility when needed. Of course, most people understand that the longer a portfolio is left to grow, the larger it can become, but life rarely follows your ideal plan. Okay, so I did an example of dividend income using Pepsi, and now let's look at another common way you can generate portfolio cash, which is by selling shares or partial shares of tickers you own. Some people call that creating your own dividend. So imagine you hold 10 shares of Amazon, which doesn't pay a dividend, and which is currently trading at about $200 a share, which means you'd own about $2,000 of it. Let's say you decide to sell 5% of your shares to come up with $100, which means you'd sell half a share and end at 9.5 shares of Amazon, along with $100 of cash you just got. Your overall value remains the same at that point, it's just spread between shares and cash. You kinda just created your own dividend, as you got some cash out of a non-dividend stock. But to state the obvious, you also sold some of your assets. Your overall ownership of Amazon stock just went down, and thus the percentage of the company you own just went down. So when people talk about creating their own dividend and that it's the same as selling shares, they're wrong. It's similar, and in fact there are some benefits doing it I'll get into, but there are also some cons such as decreasing your ownership in the company. That means you'll miss out on any compounding and future returns that the sold shares could have made. However, if the company is growing fast, which is what people hope for with growth-oriented stocks like Amazon, then your overall value in the stock can still trend up, even if you're selling small amounts of it. And that's one big reason why people who create their own dividends prefer that approach. Their point is that as long as the stock grows, and growth stocks tend to grow more than conservative stocks, then who cares if you lose a bit of ownership when you sell, since your overall value is still trending up. Plus, they'd say that when a dividend is paid out, or more specifically on its X date, the price of the stock drops by the amount of the dividend, so what's the difference? And they'd say, okay, maybe your percentage ownership didn't fall by getting a dividend, but it's effectively the same thing because you now own the same amount of an asset that is worth slightly less since the dividend cash just came off their books. And to highlight some of what I just said, let's start by looking at this data on Pepsi. This is a chart in Fast Graphs, which I'm an affiliate of because I love their tool, that shows Pepsi's shares outstanding and buybacks over time. So like in 2004, there were 1.73 billion Pepsi shares, and over time they slowly bought their shares and retired them, and today are at about 1.38 billion shares. That means they've retired about 350 million shares in 2 decades. That also means that anyone who owned Pepsi stock and didn't sell it would now own a greater percentage of the company because there are less shares out there, and that highlights one reason why I love to buy and hold quality companies. Now, most of you know that buybacks and dividends are the 2 main ways companies return cash to shareholders. Dividends are the more direct method, while buybacks can increase your ownership percentage and often boost share prices by increasing earnings per share, as stock prices tend to gravitate towards earnings. Okay, so we see that there are 1.38 billion Pepsi shares, and I told you that they paid out $5.69 per share per year, which means they pay out over $7.5 billion in divvies per year. And this Pepsi press release says that they did total cash returns to shareholders of approximately $8.6 billion, comprised of dividends of $7.6 billion and share repurchases of $1 billion. So bottom line, Pepsi sells lots of products, and they end up with lots of profits, with the material portion going to their shareholding owners, like me. Some of that profit they may use to grow, doing things like buying companies or whatever. But when they pay dividends, the cash they hold gets transferred to shareholders, so even though you're getting paid a dividend, your percentage of the cash is just transferring out of the bank coffers of Pepsi and going into your brokerage account. And that's a key point the dividend naysayers make. It's not free money, it's just some of your company's profits which they transferred to shareholders. So you might have retained the percent ownership in Pepsi by getting a dividend rather than selling shares, but you ended effectively the same point because you own the same percentage of an asset that is now worth billions less due to it transferring dividend cash off its books. But now let's get back to the point about the stock price dropping by the dividend on its X date. What actually often happens is that stock prices typically drop by about 90% of the dividend amount on the X dividend date, on average, not the full amount as theory would suggest. Multiple studies have explored why this discrepancy exists, with explanations ranging from tax considerations to investor preferences to behavioral factors. Regardless of the exact cause, this pricing behavior can give dividends a slight edge over selling shares to create your own dividend. And while a 10% difference might seem small, the fact is over decades of compounding, even modest percentage gaps can lead to significant differences in long-term returns. And maybe that's part of the reason why dividend stocks outperform non-dividend stocks on average over the long term. So this is a fascinating case of theory not meeting reality, and why selling shares to create your own dividend is not the same and is slightly worse than actual dividends. But beyond that, there's also the reality that selling shares often takes active effort along with knowledge, and for many people there's also stress involved. Compare that to dividends. I mean, my dividend income flows in regardless of what I do, regardless of what mental state I'm in, whether I'm on vacation or sitting in a hospital bed or whatever. I've got things set up in my broker so that my taxable account dividends automatically flow into my bank checking account, which is where some of my bills automatically get paid. Thus, I don't have to log into a brokerage, I don't have to determine which stocks to sell, I don't have to stress about the market being lower or whatever. I just go along my merry way and I get some of the profits that my companies have made that are sent to me as dividends. Now, some people will say, yeah, but it's minimal effort to log in and place a market order and move on, and that's true, but it still is effort and time and knowledge. Like, I love my wife, but she's absolutely terrible with numbers, and I'd be scared to see her try to sell a stock in our portfolio if I wasn't around. That being said, you still have options to do similar things with non-dividend stocks. Like, some people pay a financial advisor to sell for them, but that has fees and can introduce some new risks of abuse occurring. Another option is using systematic withdrawal plans or recurring sales, which are what some brokerages offer. Basically, you enroll in their program and specify the amount you want to sell and how frequently you want to sell. Maybe 0.33% of your portfolio each month or 4% annually. You can decide to sell a little from each position or do custom allocations where you choose which stocks or funds to sell. You can also usually elect to withhold taxes automatically if you want. So lots of ways to skin a cat. I personally hate the idea of selling my assets automatically, and I'm happy that I have passive dividend income coming in that my wife and kids can benefit from without knowing or doing anything. And the older I get, the more I value my dividend strategy. I'm really not a fan of selling, as that increases the risk of seeing your portfolio disappear. And in my last video, I shared a new study that was done this year that found that the classic 4% retirement rule would have left more people selling out of their portfolio prematurely, depending on if they retired and there were long periods of low market performance coupled with high inflation. They found that it's apparently worse than the original expectation of portfolios lasting for 30 years in 95% of cases. For example, if you had $1 million portfolio and the market in your stocks went basically sideways for 19 years and inflation was at 3.5% and you were doing the 4% selling rule, then you would run out of money in 22 years. Even with bonds, including inflation-protected ones, the lack of real returns probably means your portfolio would still shrink because withdrawals outpace growth. Bonds may soften the ride or cover income temporarily, but they generally won't make up for decades of stagnation. Now, you might say that it's unrealistic to think that we'd go sideways for 20 plus years, but we actually went sideways for 25 years from 1929 to 1954, and we went sideways for 17 years from 1965 to 1982. Plus, don't forget the lost decade in the 2000s, and your portfolio runs out even faster if inflation is higher. History has shown us that the worse the market does, the larger part of your total returns to dividends become, and have even been 100% of your returns in really bad decades. And if in those flat markets your portfolio's average weighted yield was 4% and your CAGR was 4% and your dividends kept paying out, then your portfolio would actually grow, as would your income. You see, when markets are rattled and stocks are crashing, a lot of value is placed on cold hard cash being made and transferred to shareholders. The stock price is a transitory thing which trends towards earnings in the long run, but in the short run is volatile and often doesn't reflect the true value of a stock. So businesses who are still making money in crappy markets, like solid dividend stocks tend to do, usually end up losing less or holding up better, on average, and history has shown us that multiple times. An interesting thought is asking yourself if a company's value actually decreases if it pays a dividend. I think you might be able to argue not necessarily. I mean, Buffett often says that the true value of a business is the cash it can generate and return to its owners over its lifetime, not what the market happens to price it at today. In the short term, stock prices mostly reflect sentiment or popularity, not intrinsic value. That's why even great companies can stay under or overvalued for years. So when a company pays a dividend and its stock price drops slightly, that doesn't mean its ability to generate future cash has changed. That drop is just a mechanical adjustment to reflect the cash leaving the company. Now, it's true that distributing cash reduces what's shown on the company's financial statements, and technically yes, that reduces the company's total value by the amount of the dividend. But if that cash wasn't going to be reinvested into high return projects or used to enhance future cash flow, perhaps because no such projects can be identified, then the company's ability to create value going forward hasn't actually changed. So if a company's future earning power hasn't been decreased by paying a dividend, and if we're valuing a company based on its future cash flowing power, then does paying a dividend actually decrease the value of a company? Kinda, because more cash is better than less cash, but not so much if you're really just looking at your ability to continue to generate cash and you assume putting that cash to growth wouldn't yield more growth. Bottom line, creating your own dividends, aka selling shares, increases the likelihood of running out of money too much for my tastes, and the last thing any retiree wants to hear is that you're running out of money. That's yet another reason why creating your own dividend isn't the same, nor as good in my opinion, as getting actual dividends. That being said, I should also mention that if you focus on assets with higher growth potential, your portfolio could grow significantly larger before you start making withdrawals. That extra growth might give you more flexibility later on. For example, holding a stock like Amazon during its explosive growth years could have given your portfolio a major boost. However, it's also worth remembering that even growth stocks can stall. Like Amazon, for instance, had a decade-long stretch where its stock price went mostly sideways. Betting on growth doesn't always pay off in the short or even medium term, and long periods of underperformance can hurt. But on average, it does make sense to focus on growth when retirement is far away. So now a question to you guys. If you had to guess, would you think we have more odds of heading into lower market returns than we've historically had? Do you think inflation might trend higher? If yes, then be aware that in those sorts of times, dividends have historically been your best source of return, on average. Okay, but now let's turn things around a bit. I mean, there are some real reasons why creating your own dividend can be better than getting traditional dividends. For example, you can create your own dividend whenever you need cash, rather than wait for your companies to pay them. That also means you can better optimize your tax situation, since you have more control over your income. Not only that, but when you manufacture your own dividend, you can determine how much cash you want. I mean, if you want a bigger dividend, you sell more shares. And beyond that, when you create your own dividend, you aren't restricting yourself to just dividend stocks, which is huge. I mean, some of the best companies in the world don't pay a dividend, so why limit yourself to just divvy stocks? Do you really want to miss out on Amazon or whatever just because it doesn't pay a dividend? Plus, some folks fixate on super high yield tickers coming from companies that are financially weak, which makes their portfolio riskier. But to be fair, dividend folks also have the option to manufacture additional dividends by selling shares, so there's that. And the reality is that I'd wager that something like 99% of investors will end up getting some dividends and selling some shares. I just have a preference for dividends, especially in retirement, but at the end of the day, the most important thing is the quality of the ticker you hold. Great companies will be great for your portfolio, dividend or not, and crappy ones will be crappy, dividend or not. Quality companies are typically stable, well-run, and able to perform over the long term, even in tough economic conditions. Investors should look to quality tickers for durability, not just short-term gains. And dividend stocks in the S&P 500 are often considered quality companies. They're often mature, profitable businesses that have typically been around for a while, have stable earnings, and don't need to reinvest all their profits into growth. So instead of letting that extra cash sit idle, they share it with their shareholders in the form of dividends. Some investors mistakenly believe that it's always better to invest cash into growth rather than return cash as dividends. But I'd say that experienced investors and smart business leaders understand that's not the case. I mean, every company has a limit to how effectively it can reinvest its profits to grow, and beyond that point, extra capital can lead to diminishing returns and even wasteful spending. That's why many mature companies often choose to return excess cash to shareholders through dividends or stock buybacks, rather than forcing growth that doesn't make financial sense. The truth is, growth opportunities are not unlimited, and once a company has invested in all the high return opportunities available, holding on to excess cash can lead to inefficiency. In those cases, returning capital to shareholders through dividends or buybacks is not just acceptable, it's the most responsible thing to do, and that's part of the reason why about 80% of the 500 or so stocks in the S&P 500 pay dividends. Those management teams realize the various benefits to dividends, and so they advocate for them to be paid out. I once talked to the CEO of a public company I worked at, someone who himself was fond of dividends, and asked him why management teams usually end up paying a dividend. And he said that the market sometimes doesn't like to see key insiders selling shares, whereas with dividends they hold onto their shares but can also get cash. I've personally found that the compounding aspect of reinvested dividends can not only be motivating, but also can enable huge portfolio gains as the decades go on. And that aligns to the data which shows how reinvested dividends are material parts of market returns. In fact, from 1960 through the end of last year, roughly 85% of the S&P 500's index's cumulative total return can be attributed to reinvested dividends and the power of compounding. So dividend-focused strategies provide the potential for good stability, consistent income, and a potential hedge against economic uncertainty for all-weather portfolios. And all that's why I feel it's silly when people bash dividends. In the end, I'd say that creating your own dividend can be more efficient and flexible in theory, but it requires discipline, planning, and a good understanding of taxes and market risks. Dividend investing often provides structure, stability, and peace of mind, which is valuable to many, especially in retirement. And as I was working on this part of the video, I took a break and reviewed some financial websites and saw an article titled, "Couple with 38K salary loses 300K while day trading." It was about some folks that had inherited a retirement account, and then they lost it all on a bunch of trades. And while that's an extreme case of being out of control, in my experience, the more people touch their portfolio, the worse they seem to do, on average. Portfolios are kind of like soap. The more you touch it, the smaller it often gets. Of course, if you know what you're doing, then you can still sell shares and do great. Anyway, in my dividend spreadsheet tool that my Patreon aristocrats and kings have access to, I created a tool called the Living on a Portfolio Simulator. You can put in starting portfolio value, your portfolio's average weighted dividend CAGR, dividend yield, a tax rate percentage, what your annual expenses are, how much inflation will be, any cash you want to invest in stocks in your simulated portfolio, and it will spit out how many years your portfolio can last. So like in this example, I put in a starting portfolio amount of 250K, a 5% portfolio dividend CAGR, a 4% starting yield, 0% taxes, so maybe a Roth, a 5% annual share price appreciation, expenses starting at 50K a year along with inflation of 3.4% with no more cash added to the portfolio, and it estimates that the portfolio would last for 6 years. If I lower expenses to 25K a year, then my simulator estimates the portfolio would last 15 years. As you play around with the tool, you can get a good sense for how dividends versus capital appreciation versus expenses and such all play out. Hopefully now you understand some pros and cons of getting dividends versus selling shares and how both can help you live off a portfolio. Again, in my experience, the people who just keep investing in decent stuff over long periods of time will most likely do well. You can go riskier with unproven high-growth stocks, or you can be more conservative with lower-growth companies that have been around the block. There isn't a one-size-fits-all answer when it comes to investing. You need to do what best enables your goals, risk tolerances, timelines, tax realities, etc. So keep learning, researching, and evolving as you head down this crazy financial journey you're on. Some of us focus on dividend stocks, and we're in good company, as we have people like Jeremy Siegel, a famous professor emeritus of finance at Wharton, who's a self-proclaimed big proponent of dividend stocks. But we also have smarties who are more neutral towards dividends, like Aswath Damodaran, a renowned finance professor at NYU's Business School, who says that dividends are neither inherently good nor bad, they're just one way of returning cash to shareholders. He says the key is whether the company has the capacity to pay them, and whether paying them is the best use of capital. What he gets concerned about is when some investors chase dividends as if they're free income, but this ignores that value is driven by overall cash flows and risk, not how those cash flows are packaged. A company that pays a dividend but sacrifices growth or borrows excessively to sustain it is destroying value, not creating it. He prefers flexible buybacks over rigid dividend policies because they allow companies to return cash without long-term commitments. My take is that it honestly all comes down to quality. Great companies are great to invest in, and mediocre ones are mediocre to invest in, especially over the long run. If you're investing in decent stuff for long periods of time, I'm pretty sure you'll do fine. And with that, I'll switch gears and tell you about my Memorial Day. So lots of my relatives are blue-collar folks. I'm talking farmers, food service workers, cashiers at CVS, and stuff like that. This weekend we went out of town to visit a bunch of them, and we ended up at a pizza place to celebrate some birthdays. I sat by my wife's brother who's a mechanic and who just had a child, and I asked him if he was investing in anything. He pulled out his phone and showed me Robinhood, and said he had invested in some crypto called Peanut the Squirrel, ticker PNUT. Yikes. I suggested that he consider investing in the SP 500 instead, which he had never heard of, so I explained what it is and how he could invest in it using Robinhood. I asked him how long he was hoping to invest for, and he said about 10 minutes because he wanted to strike it rich on that crazy altcoin. I suggested that if he wanted to gamble for fun, then limit it to 5% of his investable cash, but put everything else in the SP 500 and then not quit if the markets go down. I also explained that over time, the market has averaged about 10% return annually. Still, there are years when it goes down and stays down for a while. But those who invest for the long term in strong American companies have generally ended up making a lot of money. Anyway, I also talked to some other relatives at the pizza place and none of them invested. The blue-collar lifestyle can be rough, and it's even rougher as most of them have never been taught about investing. Very few people are influenced to invest their cash. And these guys said that if they had surplus cash, their first instinct was to buy a new four-wheeler or get a skiff or maybe mod out their truck or whatever. So hopefully your takeaway from this whole episode is to invest in stuff non-stupidly, avoid get-rich-quick investments, and I'm confident over the long run you'll be happy. Leave me a note and tell me if you plan to live off your portfolio someday, and whether that will be mostly selling shares or what have you. Beyond that, I ask you to kindly do me a favor and hit that thumbs up button, subscribe if you haven't yet, and click that bell notification. And as a way to show my gratitude to people who leave really nice comments, I'm going to shout out 10 subscribers who've done just that. So thank yous go out to 1 Dan Blues, Robert C., Jeezy Sprout, Dorake Divs, Jeff Teeples, Luke Miller 1385, Joy Gatewood 8028, Buzz 623, Lister Bliss, who coincidentally just started a channel on YouTube and gave me a shout out recently, so check her out, and last but not least, Drowl22. Thanks folks, I really appreciate it. Now I'd like to pitch a few quick things, starting off with my FastGraphs affiliate link along with my coupon code in the description of this video, as using both will allow new users to get 25% off their first payment even if they sign up for a full year. Also check out my Seeking Alpha affiliate link, as new users often get benefits for signing up. Finally, please check out my Patreon page and or consider joining my channel membership, as both have some cool perks you might like. I'll close this off by recommending that everyone join my free Dividend Discord chat server, which has over 11,000 Dividend investors on it from 85 countries around the world. Thanks for watching, stay positive, and I'll talk to you again real soon. Remember, I'm not a financial advisor, and my videos are for entertainment and inspirational purposes only. Investing of any kind involves risk. I'm only sharing my opinions with no guarantee of gains or losses on investments.